Hello friends, as we all know the mutual funds, we are seeing so much ads on the TV and on the internet. There are various options available in mutual funds and many people investing in it with their financial goal. In this video, we will see one type of mutual fund which is index fund. What is index fund? Index fund is a fund which invests in a stock which are in Sensex and Nifty. Index fund replicates the Sensex and Nifty. It have some advantage and disadvantage. Let's look at the advantage. Index fund is a passive managed fund, so it have a low expense ratio. Index fund gives average return to their investor. Now look at the disadvantages. Index fund don't take high risk, so it gives average return and balanced return to their investor. The aim of this fund is not to beat the market, but is to match the return with the Sensex and Nifty. Then why to invest in index fund? There are main 3 points which should consider before investing in the fund. First is knowledge. In active fund, you require to check which stocks are held in the mutual fund. In index fund, you don't require to do that because index fund in itself investing in a stock which are top performing company held in the Sensex and Nifty. Second point is a risk. Index fund in itself, it is a diversified fund. So the risk also is diversified. The risk involvement in the index fund is low. Third point is return. As index fund not taking high risk, so it give balance and average return to their investors as compared to the active fund. Now we will see some comparisons. First is index fund versus active fund. Index fund is a passive managed fund. Active fund is actively managed fund. Actively managed means fund manager involved in the research of a stock, research of the market, collecting data and other things to manage the mutual fund. Index fund have a low expense ratio, active fund have a high expense ratio. Index fund gives average return with the low risk. Active fund gives high return with the high risk. Now look at the comparison between the index fund and the ETF. ETF is nothing but exchange traded fund. In index fund, you don't require demat account to start. In ETF, it is compulsory to have a demat account to start. In index fund, you have both options, lump sum and SIP. In ETF, you have only one option, that is lump sum. Index fund, you can start with the minimum amount of 500 rupees in SIP. In ETF, you require minimum 10,000 rupees to start. Now we will see the two main ratios which should every investor consider before investing in any mutual fund. First is exit load. Exit load is a percentage which are applicable when investor redeem its amount before their defining locking period. The locking period vary from fund to fund. If investor redeem its amount within the locking period or before that locking period, then some amount get deduct from their invested amount. Second is expense ratio. Expense ratio is a percentage which cuts from the investing amount. This expense ratio includes the efforts taken by the manager to collect the data, to analyze the data, and to using various tools for investing in the research. The amount required to all this expense ratio is come under this. This also cut from the invested amount. If you know more about the index fund, then please visit to investmonday.com. Thank you for watching.